after the excitement surrounding the UK's general election result, or, from the narrow, selfish perspective of financial markets, the lack of excitement, judging by the minimal subsequent movements in the stock market, gilt yields and sterling that followed, attention will now return to the macroeconomic and corporate news in the week ahead. UK inflation figures on the 18th of July, unemployment and wage growth on the 19th, and the GfK Consumer Confidence Survey on the 20th will all give some feel for the new Labour government's economic inheritance. Meanwhile, the pace of corporate news will pick up on both sides of the Atlantic as second quarter and first half results and trading updates start to come thick and fast. One sector that will be well and truly under the microscope in this coming week is mining, given that Rio Tinto, Antofagasta and Anglo American will release second quarter updates on the 16th, 17th and 18th of July, ahead of the release of their actual first half figures later in the summer. Anglo American reports on the 25th of July, Rio on the 31st, and Antofagasta on the 20th of August. The timing of these trading updates is interesting, as all three miners are heavily exposed to copper in particular, and the industrial metals price is just starting to pull back after a strong run. A soft spot in electric vehicle sales, fears over China's sluggish recovery, coupled with loose but unconfirmed chatter that Beijing had moved to stockpile the metal ahead of a possible announcement on the value of its currency, well, they have all taken their toll. And this has happened even as many metal traders and economists have continued to extol the investment case for copper. This is based upon the decarbonisation trend, whereby national grids and power infrastructure have to be overhauled and renewed to connect renewable energy sources. They also need to meet an ongoing increase for demand in electricity, thanks to all of those data centres and servers that keep whirring to get artificial intelligence and large language models on the go. You've also got the ongoing rise, in theory, of electric vehicles. It's possible that both the short-term and the long-term views are right, although real bulls of commodities will point out that new mine development remains subdued across a range of raw materials, thanks to the price stumble seen in the middle of the last decade, the need to reduce debt after an acquisition spree and capital investment splurge at miners, and also pressure from environmental groups not to knock any more holes in the Earth's crust. Real believers in a new upward cycle for commodity prices will also assert that raw materials are a potential store of value in the event of a sustained inflationary outbreak, or even, hold your breath, a return to quantitative easing by central banks should public debt burdens become too much. One big test near term may be whether the Commodity Research Bureau, or CRB index, can break to new 10-year highs or not in absolute terms, and it measures a basket of 19 different commodities. Another will be whether that same index can continue to forge a recovery relative to the FTSE All-World Equity benchmark, a recovery that started in 2021, which was when, perhaps not entirely owing coincidentally, inflation reared its head. Antofagasta is nearly a pure play on copper, barring some output of molybdenum and gold, while Rio is more exposed to iron ore and aluminium, with copper ranking third by profits in 2023. Copper is the second biggest earner at Anglo American last year, also behind iron ore, although it is now 30% of the company's total output. Note that Antofagasta is actually the sixth best performer in the FTSE 100 over the past year, compared to Anglo American at 60th and Rio at 70th. Antofagasta's cleaner exposure to copper could be the reason for that disparity, even if it's thought that BHP's bid for Anglo American was based on a desire to get hold of the target's copper assets. This takes us to the trading updates themselves, which will focus on output and costs, and particularly relative to guidance given early in the year. Details on the balance sheet, cash flow and profit and loss account will come with the actual first half numbers, although do watch out for any changes in output forecasts and targets, as well as comments on cost of production and capital investment, since all of those will directly influence profits and cash flow down the road. In chronological order, the key points to follow will be these, relative to the guidance given by the respective chief executives, Jakob Stausholm at Rio, Ivan Arriada at Antofagasta, and Duncan Wanblad at Anglo American. At Rio, expectations are for higher copper and alumina output this year, with no change in iron ore, bauxite and aluminium. Iron ore cash costs are forecast to be somewhere between $21.75 and $23.50 a tonne, up from $21.50 last year, with copper between $1.40 and $1.60 a pound, below last year's $1.90, and that's thanks to increased output at Oyu Tolgoi in Mongolia, and at the Kennecott smelter in America. At Antofagasta, copper output's forecast to come in between 670 and 710,000 tonnes, higher than last year, with sequential improvement throughout 2024, with cash costs of around $1.60 a pound, flat year on year. And finally, Anglo-American, guidance was initially for flat output in iron ore, platinum group metals and steel-making coal, with drops in copper, nickel and diamonds. Mr. Wanblad then cut forecast for diamond production with the first quarter update, and an incident at Grosvenor in Queensland, Australia, could threaten the steel-making coal target too, to put further pressure on the FTSE 100 firm as it looks to win over shareholders after fending off that bid from BHP. I hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.